Order blocks are one of the most talked about concepts in smart money trading. You see them everywhere, on Twitter and Discord servers and YouTube videos. But here's the thing nobody really talks about. Most traders treat all order blocks the same, and that's exactly why they keep getting burned. The truth is, not every order block deserves your money. Some are genuinely high probability setups. Others are just candles on a chart that happen to look the part. Knowing the difference is what actually moves the needle in your trading. So in this video, I'm going to walk you through the exact conditions that make an order block worth trading. We'll cover how to identify a valid one, what market conditions give it the best chance of working, and I'll show you some real chart examples at the end so you can see how this actually looks in practice. Let's get into it. Before we talk about quality, we need to get the basics right. An order block, in its simplest form, is the last candle before a significant impulsive move. It's the candle where institutional activity most likely took place, and that's why price tends to return to it later. But not every candle before a move qualifies. There are three things I look for before I even consider an order block tradable. First, inefficiency. The move coming out of the order block needs to be impulsive enough that it leaves a gap in price, meaning the candle shadows don't overlap. This gap, or fair value gap, tells you the move was strong and one-sided. If the move out of the zone was slow and overlapping, the conviction just isn't there. Second, structural significance. The order block should lead to either a break of structure or a change of character. A BOS tells you the trend is continuing. A CHoCH signals a potential reversal. Either way, the move needs to mean something structurally. Otherwise, it's just noise. Third, it must be unmitigated. Order blocks are one-time setups. Once price has come back and traded through that zone, it's done. You're looking for first-touch opportunities only. An already tested zone holds far less significance than a fresh one. Once you've identified a valid order block, the actual entry logic is straightforward. You place your entry at the top of the order block zone, put your stop loss at the bottom, and aim for at least a 1-to-2 risk-to-reward ratio on your target. The reason the 1-to-2 RR matters is simple math. With that ratio, you don't need to be right the majority of the time to be profitable. Your winners carry more weight than your losers. This is the baseline setup. Clean, rule-based, and easy to execute. But the setup alone is not enough. The conditions around it matter just as much. And that's what we're going to get into now. This is where most traders leave money on the table. They find a technically valid order block and take the trade without asking. Is this the right context for this setup? Let's break down the four conditions that separate a mediocre order block from a high-probability one. The area around your order block tells a story. You need to read it before entering. Here are three patterns to look for. Caution signal. If there's a visible gap or another valid order block sitting directly below your setup, be careful. Price has unfinished business below. There's a good chance it will push down first to fill that gap and grab liquidity before it eventually moves in your direction. This doesn't mean the trade won't work, but it does mean the path to your target might be messier than expected. Positive signal. When the order block formation also swept the liquidity under equal lows, or above equal highs, that's a strong sign. The market has already done the dirty work of running stops, which can fuel the next directional move. A setup like this tends to have cleaner follow-through. Also positive. If price is approaching your order block and there's a clear support zone in front of it with stacked equal lows underneath, retail traders are loaded with stop losses just below that level. The market will likely dip to take those stops, then use your order block zone as the launch pad. That's a very readable, very common pattern. One important mindset shift. A break below a key level doesn't automatically mean the market has flipped bearish. In many cases, it's nothing more than a liquidity sweep before the real move happens. Train yourself to think in terms of liquidity, not just support and resistance. Quick break before moving forward. If you're serious about trading and want to stop guessing entries, I built the exact tools I personally use every day. On the dtctools.com, you'll find our complete CCT and DTC strategy suite, including custom indicators, MT5 bots, and fully automated signals. And just to give you real numbers, in the last week alone, CCT took 7 trades, 4 wins, 3 losses, and still delivered 7.4 R total with a 2.6 average risk to reward. So even with losses, the system stays profitable. That's the power of proper risk management. Also, if you decide to grab any of the tools, you can use the code Telegram20 for 20% off everything on the site. If you want structure instead of stress, check the link in the description. All right, let's get back to the chart. Timing matters more than most people realize. Order blocks require volume and participation to be respected, and that means you want to be trading when the market is actually moving. For pairs like EURUSD, that means the London session and the New York session. These are the windows where institutional players are active. Outside of these windows, price tends to drift without real conviction, and your setups are far more likely to get chopped out. Mondays and Fridays also tend to be lower quality in terms of liquidity and follow-through. Midweek is generally where the cleanest moves happen. That doesn't mean you completely ignore Monday or Friday setups. Just apply extra scrutiny. On the spread side, order blocks can be respected within a single pip. If your broker has wide spreads, you will either miss valid entries entirely or get stopped out on trades that technically shouldn't have been stopped. Choose tight spread instruments and always account for spread when placing your stop loss. Trading with the dominant trend is one of the highest leverage things you can do with order blocks. When you're aligned with the macro direction, the market is essentially working with you. Counter-trend order blocks can work, but they require much stronger confluence and a clear structural reason for a reversal. Freshness is equally important. The longer an order block sits untested, the more the market environment around it changes. New demand and supply zones form, structural levels shift, and the original order block loses its relevance. As a general rule, the fresher the zone, the stronger the case for trading it. Look for situations where the market is trending cleanly, printing fresh order blocks as it pulls back, and then continuing in the same direction. That's the pattern you want to be trading, not chasing a zone that's been sitting dormant for weeks. This is arguably the most important filter of all. Even when you have a valid order block in the right context with good volatility conditions and trend alignment, price can still reject your zone. Lower timeframe confirmation is how you avoid walking into setups the market has no intention of honoring. The approach is to identify the order block on your higher time frame, then drop 2 timeframes lower for your actual entry. So if your OB is on the 4-hour, you're executing on the 15-minute. If it's on the 1-hour, you're on the 5-minute. If it's on the 15-minute, you're on the 1-minute. Once price taps into the higher time frame zone, you wait. What you're looking for is a change of character on the lower time frame, a sign that the short-term move into your zone is losing steam and reversing. From there, 2 entry patterns are worth knowing. Entry pattern 1, CHoCH with inefficiency. If the change of character move creates a fair value gap and its own valid order block, that's your entry. Place your order above that lower time frame order block, stop below the swing low, and trail your stop under each new higher low as the trade progresses, close at the next significant supply zone. Entry pattern 2, CHoCH without inefficiency. Sometimes the CHoCH move is clean but doesn't leave a gap. In that case, use the Fibonacci retracement. Draw it from the start to the end of the CHoCH move and look to sell between the 61.8% and 78.6% levels. Stop above the swing high, target the next structural low. The takeaway from all of this is pretty simple. Order blocks don't work in isolation. The concept itself is solid, but whether a specific setup actually plays out depends on the conditions around it. Every time you spot an order block, run it through these 4 filters. Is the market structure clean? Are you trading during the right session? Is this aligned with the dominant trend and is the zone fresh? And does the lower time frame give you a proper reason to enter? The more of these you can check off, the better your case for taking the trade. And when a trade doesn't work out, analyze it, learn from it, but don't throw the concept out the window. No setup in trading has a 100% hit rate, and that's completely normal. The goal is a consistent edge over many trades, not perfection on every single one. Before we wrap up, just a quick reminder. If you want to get access to our advanced tools, you can visit us at thedtctools.com. If you want the same indicators, MT5 bots, and automated signals, you'll find them there. And you can use code TELEGRAM20 for 20% off. Links in the description. If you have questions about anything I covered today, drop them in the comments below. And if this was useful, a like goes a long way in helping this content reach more traders. See you in the next video.